Welcome back everyone to the Canadian Real Estate and Mortgage channel. Today's video we will be covering how much you need for a down payment. First things first, what is a minimum down payment? A down payment is the amount of money you put towards the purchase of a home. Your lender deducts the down payment from the purchase price of your home. Your mortgage covers the rest of the price of the home. The minimum amount you need for a down payment depends on the purchase price of your home. If your down payment is less than 20% of the price of your home, you must purchase mortgage loan insurance. Let's take a look at Table 1. Table 1 goes over the minimum down payment based on the purchase price of your home. If the purchase price of your home is $500,000 or less, you need a minimum down payment of 5% of the purchase price. If the purchase price of your home is $500,000 to just a fraction under $1 million, you need to put 5% down for the first $500,000 for the purchase price and then 10% for anything above $500,000. Finally, if the purchase price of your home is more than $1 million, you need to put a minimum down payment of 20% of the purchase price. If you're self-employed or have a poor credit history, your lender may require a larger down payment. Normally, the minimum down payment must come from your own funds. It's better to save for a down payment and minimize your debts. Let's do a quick example on how to calculate your minimum down payment. The calculation of the minimum down payment depends on the purchase price of the home. If the purchase price of the home is $500,000 or less. Let's take an example of $400,000. You need a minimum down payment of 5% of that purchase price, which in this case would come up to $20,000. But what if the purchase price of your home is more than $500,000? How do we make this calculation then? Suppose the purchase price of your home is around $600,000. You can calculate your minimum down payment by adding two amounts. The first amount is 5% of the first $500,000, which is equal to $25,000. The second amount is 10% of the remaining balance of $100,000, which is equal to $10,000. Add both amounts together, which gives you a total of $35,000. And that is how you calculate your minimum down payment. Let's take a step back and talk about mortgage loan insurance. Mortgage loan insurance protects the mortgage lender in case you can't make your mortgage payments. It does not protect you. Mortgage loan insurance is also sometimes called mortgage default insurance. If your down payment is less than 20% of the price of your home, you must buy mortgage loan insurance. Your lender may require that you get mortgage loan insurance even if you have a 20% down payment. That's usually the case if you're self-employed or have a poor credit history. Mortgage loan insurance isn't available if the purchase price of your home is more than $1 million or the loan doesn't meet the mortgage insurance company standards. Your lender coordinates getting mortgage loan insurance on your behalf if you need it. Let's break down the cost of mortgage loan insurance. The fee you pay for mortgage loan insurance is called a premium. Mortgage loan insurance premiums range from 0.06% to 4.5% of the amount of your mortgage. Your premium depends on the amount of your down payment. The bigger your down payment, the less you pay in loan insurance premiums. You can pay your premium by adding it to your mortgage or with a lump sum up front. If you add your premium to your mortgage, you pay interest on your premium. The interest rate is the same as the one you're paying for your mortgage. Ontario, Manitoba, Quebec apply provincial sales tax to mortgage loan insurance premiums. Your lender can't add the provincial tax premiums to your mortgage. You must pay this tax when you get your mortgage. How does the down payment affect the total cost of your mortgage? Save as much as you can for your down payment. The bigger your down payment, the smaller your mortgage, which can save you thousands of dollars in interest charges. Let's look at an example of how the size of the down payment affects the cost of a mortgage. Suppose you buy a home that costs $400,000. Let's assume the following. Your interest rate is 4%, the amortization period is 25 years, the payment frequency is monthly. Mortgage loan insurance premiums are added to the mortgage. Table 2 breaks all of this down. If the down payment is 5% or $20,000, that gives you a mortgage of $380,000. With mortgage loan insurance premium, that adds an additional $15,200, giving us a total of $395,200. Therefore, the total cost of your home comes down to $643,649. Now let's look at an example. If you put a down payment of 10% or $40,000 down, your mortgage would be $360,000. With the mortgage loan insurance premium, you would pay an additional $11,160, giving you a total of $371,160. And the total cost of your home would be $625,712. Now, let's look at if you put a down payment of 20% or $80,000 down. Your mortgage would then be $320,000. You would not need mortgage loan insurance premiums. Therefore, your total mortgage would only be $320,000, and the total cost of your home would be $584,979. There are various plans present to help you buy a home. There is the Home Buyers Plan. To help you come up with a down payment, you may be eligible for the HBP. The HBP allows you to withdraw up to $35,000 tax-free from your registered retirement savings plan. You must use this amount to buy or build a qualifying home. You have up to 15 years to repay the amounts you withdraw. Before you sign up for the HBP, consider if you can make the repayments, if withdrawing funds impacts your retirement savings. Also keep in mind, not making the repayments could end up costing you a lot of money in income tax, and you may lose out on any growth in your RRSP while the funds are withdrawn. Then we also have the first-time homebuyer incentive. First-time homebuyers may be eligible for shared equity mortgage with the Government of Canada. With a shared equity mortgage, the government offers you financing without interest. This helps reduce your monthly mortgage payment without increasing your down payment. Through the first-time homebuyer incentive, the Government of Canada offers a first-time homebuyer 5% of the purchase price of an existing home, or 5% or 10% of the purchase price of a newly constructed home. You need to repay the incentive after 25 years or when you sell the property. You can also repay it at any time without a prepayment penalty. The property's fair market value at the time of repayment will determine the repayment amount. To find out if you're eligible for the first-time homebuyer incentive, visit canada.ca. For more information on all things mortgages, real estate, and personal finance, be sure to follow the Canadian Mortgage and Real Estate channel. Be sure to give this video a like, subscribe to our channel, and stay tuned for more.